The postmortem https Bjorn Snyder, Substack.com. The postmortem 94 isn't good enough anymore. Bjorn Snyder, June 7, 2026. My kid brought home a 94 on his calc exam last week. A 94, in my day that was a let's order pizza number. A yes son, you can get the double fudge sundae with extra whipped cream from Baskin-Robbins number. Instead, he slunk through the door like he'd been booted from his crew boat. Because somewhere along the line a 94 stopped being an A and started being a letdown. The expectation wasn't a good grade anymore. It was a perfect one. Anything short of 100 and there are questions and furrowed eyebrows. Welcome to Broadcom's week. The stock had ripped roughly 50% in a month, heading into its print. So when it reported AI chip numbers that were merely very good and guided just a touch light, the market didn't throw a party. It grounded the stock and confiscated everyone's phone. Semis, optical, data centers, memory, all sent to their rooms. This is what price to perfection actually feels like in practice. When you've already penciled in the 100, a 94 is a sell signal. And after a 9-week win streak that had the S&P printing record after record, the tape finally found something it didn't like. Two questions are now hanging over everything. Is the AI trade still intact, and is this market priced to perfection? But first, the thing that actually moved the needle this week. And it wasn't a chip. Thanks for reading the postmortem. If you want this to consistently land in your inbox, then you know the deal. Cuts are dead, hikes are live, away from the AI soap opera. Inflation quietly took back the narrative. Friday's jobs report ran way hotter than expectations, at plus 172,000 against the 188,000 the street had penciled in, while unemployment remained steady at 4.3%. At face value, this is great. For a market hoping for a rate cut, not so much. As Noshad Shah from Citadel Securities frames it, the labor market isn't running hot yet, but it's bending that way. Firings are historically scarce, hiring is muted, and a tighter immigration regime has quietly choked off the supply of workers. Add a real pickup in growth to that mix, and wages can squeeze higher, faster than anyone's spreadsheet assumes. Next week we get the May CPI, and consensus is bracing for an ugly one. Off 4.2% headline against 3.8% in April. Should this be the case, it will be the highest reading in years. And it's not the kind of number that buys the Fed any cover. Which is the whole problem for new Fed Chair Kevin Warsh. For months, the only debate was when the cuts arrive. That trade is dying on the vine. We've quietly shifted to pricing a hike. And this isn't me reading tea leaves, it's the Fed talking. Governor Waller went from advocating cuts to arguing the committee should scrap its easing bias entirely. And Dallas Fed President Lori Logan has openly floated that rates may need to go higher. Warsh got this chair partly because the administration wanted a dove. The data is handing him a hawk's job description. The Fed wants to cut. Trump wants to cut. The numbers won't let either of them. Even Google passed the hat, and Buffett chipped in. Monday, Alphabet, one of the great cash machines ever assembled, announced it's raising roughly $80 billion to feed its AI compute habit, which included a $10 billion private placement to none other than Berkshire Hathaway. The bears pounced immediately, with AI capex set to reach a mind-boggling $700 billion already for 2026. If the most profitable company on the planet can't self-fund its AI ambitions, the whole thing is getting ahead of itself. So the thought goes. That said, Google actually traded relatively well on the news, especially on a relative basis against the rest of the complex. Is the AI trade still intact? I don't want to get fired because I'm not a financial advisor. Answer is a non-committal, probably. But it's not the hyperscaler trade you fell in love with. Here's what the trade has going for it. The earnings underneath are material. Anthropic's ARR is reportedly climbing toward $50 billion, with funding chatter floating a $900 billion valuation. And Dell's AI server revenue has exploded something like 750% year over year. That's not a story you tell on a pitch deck. That's cash through the door. Like I wrote about last week, capital didn't walk away from the theme. It climbed down the stack, into the bottlenecks, semis, memory, power, cooling, the unglamorous plumbing that actually makes the whole thing run. That leg of the trade is alive and well. The wrinkle nobody's pricing yet is cost. When harking back to Internet 1.0 and the proliferation of software, it is essentially free to hand to the next user. Serving customer number 1 million costs you almost nothing. AI doesn't work that way. Every prompt burns compute, and compute is a real recurring bill that never goes away. So the bull case quietly leans on one assumption, that the value AI throws off grows faster than the cost of producing it. The binding constraint might not be how clever the models get, but whether running them at scale actually maths out. And the early evidence is starting to nag at that assumption. Big enterprises are picking through their AI invoices line by line. Stories of jaw-dropping token bills are making the rounds. Plenty of those dazzling agentic workflows look like magic right up until someone hands the bill to a CFO. None of it is fatal yet, but if AI turns out to be pricier to deploy than the bulls assume, adoption slows, and the revenue curves baked into today's valuations start to look a touch too hopeful. Apollo chief economist Torsten Slok notes the surge in new U.S. business formation is being fueled by AI and large language models, which are dramatically reducing the cost and complexity of launching a company. Is the market priced to perfection? In a word, increasingly. Exhibit A is the Broadcom reaction up top. When good gets sold, the market is telling you the bar is set at the ceiling. Exhibit B is the math underneath. The 10-year is pushing 4.5%, and the 30-year is flirting with 5%. And rising yields are a wrecking ball aimed squarely at the long-duration growth names doing all the heavy lifting. Exhibit C is breadth. Recall Bank of America's Hartnett flagged that only 4% of the S&P is making new highs, a setup he compared not gently to March 2000. Stack that against the optimism. Goldman's at 8,000 on the S&P. Consensus is calling for 20% plus EPS growth. Gorgeous numbers if everything goes right. Price to perfection means there is no margin for a 94. The tape. The 9-week party finally got a noise complaint. After weeks of parabola, the AI tech complex finally took a nosedive, and Friday was ugly enough. The major indices off 4%, to make everyone wonder whether it's a one-day gut check or the start of something. Broadcom's merely great print handed the tape its excuse to ring the register on anything AI adjacent. Semi's optical data centers memory hit across the board. Some of the frothiest themes like space and non-profitable tech saw double-digit sell-offs. The offset came from the corners that have been benched all year. Banks, healthcare, industrials, and value all finally caught a bid. The rose-colored glasses view is that's the broadening bulls have been begging for, even if it arrived on a red day. The wrap. So, here's the setup heading into next week. Inflation grabbed the mic back. The Fed's easing bias is on life support, and a hike is suddenly the live scenario, with a 4.2% CPI landing next week to test everyone's blood pressure. The AI trade is still standing, just not as tall as a week ago, but at some point the cost question will be too hard to ignore. That's the skeleton in the closet nobody wants to open. The broad market is priced like it's bringing home straight hundreds, which is exactly why Broadcom's 94 hit the way it did. The streak is broken. Whether that's a healthy nap or the opening act of something bigger is the question everyone's chewing on this weekend. My kid will bounce back from the 94. A market priced for perfection doesn't get to grade on a curve. I'm a Wall Street trader at a $200 asset manager. Every week I break down what just happened in markets, what drove it, and why everyone reacted the way they did. Think of it as the debrief you actually want to read. Written the way I'd explain it to a friend over a beer. All thoughts are my own. Nothing here is investment advice. If this was worth your time, help it find someone else. bjornsnyder.substack.com. Hit the like. It takes 1 second and tells the Substack algorithm this note is worth reading. Restack. It helps keep those in your network well informed. Drop a comment. I love to hear different thoughts and perspectives. Thanks for reading the post-mortem. If this resonated with you, feel free to share it. Share.